So you've been hearing a lot of people in crypto talk about ETFs, and you're wondering what that is and what the big deal is when it comes to the crypto market as a whole. I'm Brett at CryptoGX, and in this video, I'll break down what a crypto ETF is, how it works, and why it's creating so much buzz in the crypto world. By the end of this video, you'll be able to explain crypto ETFs to your friends like a pro. First off, what is an ETF anyway? Think of an ETF as a basket of assets you can trade on the stock market, just like you would with a single stock. For example, an ETF might track the price of gold or follow a stock index like the S&P 500. You buy shares of an ETF through a regular brokerage account, and each share gives you exposure to all of the assets in that basket. In other words, an ETF lets you invest in many different things all at once with one simple purchase, which is pretty neat for diversification. And since ETFs trade on exchanges throughout the day, you can buy or sell them very easily, just like you would with any other stock. So what is a cryptocurrency ETF? A crypto ETF is simply an ETF that focuses on cryptocurrency assets. Instead of gold or stocks, a crypto ETF tracks the price of one or more digital coins like Bitcoin or Ethereum. These funds, as they call them, trade on traditional stock exchanges, which means that you can buy a Bitcoin ETF or an Ethereum ETF right from your usual trading app or brokerage, basically something like Fidelity or even Robinhood. Now, the cool part is that you get exposure to crypto without having to actually buy or store actual crypto in a literal blockchain wallet. So for example, if you buy a share of a Bitcoin ETF, its price is still going to raise and fall along with Bitcoin's regular market. The difference is that you won't need to manage a crypto wallet or worry about private keys, aka your share of Bitcoin is going to be on your brokerage if you were basically being unsafe with your wallet. Otherwise, obviously holding your keys, holding your coins is the way to go in the future so that you can have real ownership of them. But in that sort of sense, you're safe from those particular kinds of hacks other than the brokerage sized hacks, which we won't get into this video, but obviously that's its whole other can of worms. Now, under the hood, crypto ETFs can work in two different ways. The first one is spot crypto ETFs. These funds buy and hold real cryptocurrency. A spot Bitcoin ETF actually holds Bitcoin in its portfolio. So if Bitcoin's price goes up or down, the ETF's value moves in sync with that. Now, the other option is futures-based crypto ETFs. These funds don't actually hold coins, but they use futures contracts instead. Futures are basically contracts, or basically just a sheet of paper, that's betting on a coin's future price. So a Bitcoin futures ETF holds Bitcoin futures rather than Bitcoin itself. The result is that it still tracks Bitcoin's price, though not really perfectly. There can still be small differences due to how these futures and contracts work and different mechanics within the pricing of these particular contracts, but generally it's pretty darn close. Now, either way, if you pick one of these, a crypto ETF lets you ride the ups and downs of the crypto market through a very familiar investment format. Just remember that if the Bitcoin price doubles, a Bitcoin ETF will likely shoot up as well, and if the Bitcoin price crashes, the ETF will also drop. Now, you might be wondering, why not just buy crypto directly? Well, crypto ETFs offer some nice benefits, especially for newcomers or traditional investors. The first of these advantages is that it's easy and convenient. Buying a crypto ETF is just as easy as buying a stock. You can use your existing brokerage account, as I mentioned before, so no need to sign up for a crypto exchange or set up a special wallet. And in this case, you won't have to manage private keys or worry about transferring coins to different wallets. It lowers the barrier to entry a lot. The second advantage is that it's regulated and secure. Crypto ETFs are often offered by regulated financial companies and trade on established stock exchanges, which adds a layer of oversight and investor protection. Professional fund managers are handling the crypto storage and security for you, so you don't have to do it yourself. Now, this means that you don't have to worry about hackers stealing your coins or making an error sending crypto to the wrong address. There's going to be fund managers or brokerages like Grayscale, iShares, Fidelity, Arc, Bitwise, and many, many more that are going to handle this for you. The ETF's custodian is going to be taking care of all of that. Plus, the custodian of the ETFs have to regularly disclose their holdings so you know what the fund owns and has in it. In short, crypto ETFs bridge the gap between the wild crypto world and then the more familiar world of stock investing. They make it easier for people who wouldn't normally touch crypto to get a piece of the action when it comes to investing, all through a platform that they're really comfortable with. Now, believe it or not, crypto ETFs weren't always around. In fact, US regulators refused to allow them for many years. The SEC, which is the Securities and Exchange Commission, was worried that the Bitcoin market was unregulated on its own and it was basically able to be manipulated. So it rejected many Bitcoin ETF proposals between 2018 through 2023. The first real breakthrough came in October of 2021 when the SEC finally approved a Bitcoin futures ETF. The ProShares Bitcoin Strategy ETF, or BITO, launched as the first US crypto ETF tracking Bitcoin via futures contracts. It was immensely popular, showing that investors were very eager for crypto in an ETF wrapping. But still, at this point, a spot Bitcoin ETF that was holding actual Bitcoin was not around. Now, this finally changed, though, in January of 2024, which was very recent, when the SEC, under some legal pressure, approved the first wave of spot Bitcoin ETFs. At this time, there was a flood of 11 Bitcoin ETFs that hit the US market, which finally let investors buy funds that actually hold Bitcoin. Not long after that, a few months, in mid-2024, the SEC also approved spot Ethereum ETFs. Both of these gigantic launches were a huge deal. The news of spot crypto ETFs sparked excitement and really a mini bull run in the crypto markets in 2024, and money poured in very, very quickly. For example, BlackRock's Bitcoin ETF, from the world's largest asset manager, attracted tens of billions of dollars in its first year. And by this year, 2025, US crypto ETFs had collectively amassed a huge amount of assets, showing how much demand there is for crypto exposure through traditional investment vehicles. Now, obviously, ETFs make crypto investing easier, but that doesn't mean that they're perfect. Here are some important caveats, I would say. Number one is crypto volatility. An ETF doesn't magically eliminate the volatility in the crypto world. If Bitcoin or Ethereum plunges 20% in a day, a crypto ETF holding those will likely drop a similar amount, or basically the same amount. It might feel safer because it's an ETF, but you're still dealing with a very volatile asset. Just the same way I would tell someone who's owning direct Bitcoin or direct Ethereum or any crypto, I would say only invest what you can afford to lose, because it's essentially like owning the same thing when it comes to the price movements. The other risk is coin ownership. When you buy a crypto ETF, you don't actually own the underlying coins. You own shares of a fund. That means that you can't use the ETF to pay for things in crypto, and you can't move the Bitcoin, let's say, out of the fund into your own personal wallet. You're trusting the fund to hold the assets on your behalf. This isn't a deal breaker for most investors. It's really the whole point, actually, but hardcore crypto fans might remind you a big saying in the crypto world: not your keys, not your coins. Another issue is fees and expenses. Crypto ETFs charge management fees that eat into your returns over time, which all ETFs do. And in fact, many crypto ETFs have higher expense ratios than regular stock ETFs. So make sure to always check the fee. Even a 1% annual fee can make a huge difference in the long run. And the convenience at this time is, not totally free. So owning Bitcoin versus owning a ETF of Bitcoin is actually going to have very different returns over a very long investment period. The last issue would be tracking differences. So if you choose a futures-based crypto ETF, it might not perfectly track the spot price of the cryptocurrency or the actual price of the cryptocurrency. Now, this is because of the cost and the mechanics of rolling over futures contracts. You don't need to know the minutia and the super detailed little bits of this, but in normal times, the divergence is minor, the difference in the price is very small. But over very long periods, a futures ETF could underperform the actual crypto by a bit. It's just something to be aware of, but not something to be insanely concerned about. Now, let's stray away from the issues at the moment, because ETFs are a very good thing for the crypto market. Obviously, as we went over, a crypto ETF is basically a stock wrapping for a cryptocurrency that lets you invest in Bitcoin, Ethereum, and other digital assets without the need to own it on a crypto exchange. For beginners, it's obviously a friendly way to dip a toe into the crypto investing market through regular investing channels like a brokerage. As we know, obviously, it's not risk-free. It gives you similar risk as it would as if you were buying the stock itself, or the crypto itself, rather. But there are some other concerns. You might be paying for management fees of this ETF, as well as, having the tracking of the price be a little different. But altogether, altogether, a ETF is good for the cryptocurrency market because it gives more people access to this particular investment, whether it's, buying it directly or buying it kind of secondarily. The more money that's going into Bitcoin or the crypto market as a whole brings up the value of that particular market, brings up the sentiment and more people involved in it, and really throws the price for a loop, as we've seen many, many times over. When ETFs get launched and tons of money goes into it, the price definitely shoots up. So the more people investing in something, the higher the price is gonna go. Overall, crypto ETFs are a very exciting bridge between traditional finance and the crypto world, and they open the door for a lot more people to participate in the crypto market. So when you hear crypto ETF announced, that means that they're applying to the SEC. Or you hear crypto ETF approved by the SEC, that means people can actually buy it now. That just means altogether that it's, number one, a really exciting time for crypto, and number two, on the horizon is going to be more people putting their money into crypto, whether it be a Bitcoin ETF, Ethereum ETF, or any other cryptocurrency. I hope that excites you like it excites me, and now that you know the basics, I'm curious what your thoughts are, if you've been seeing ETFs out there and what that means for you, if you're going to be jumping into crypto or if you're already in. If you are ready to get in and aren't already, I've left some links to Coinbase and crypto.com where you can get at least $50 in crypto just for signing up with those links. And if you're interested in meme coins, I left a link to MoonShot where you can get some free meme coins when you sign up. If you learned something new or just enjoyed this video, make sure to hit the like button and hit subscribe if you want to stay tuned for all things crypto. Thanks for watching. I'll catch you in the next one.